Let us now talk about price multiples. And as an introductory remark, price multiples are used frequently in stock analysis, and hence it's extremely important to understand this concept. Let's start by talking about what do we mean by price multiples, and the best way to understand this is to simply look at some examples. The most commonly used price multiple is the price earnings ratio. Sometimes this is called PER, but in the CFA curriculum this is generally referred to as P over E. So this is the most commonly used multiple, or the most commonly used price multiple, and it stands for the share price. So if at a given point in time the share price is 50, and E stands for earnings per share. So this is EPS. The EPS that we calculated when we studied the income statement earlier in this course. So this is that earnings per share. Just keep in mind that all the multiples we talk about, all the price multiples will have the share price, the current share price in the numerator, and it will have some value related to the company. So in this case it is the earnings per share. So the value related to the company will always be a per share value. Since the price is the price per share, the denominator also will be something per share. In my example here, the something is the earnings. So if the earnings per share for this company is 5, so if we have $5 per share as our earnings, the share price is $50 per share, then the price earnings ratio or the price earnings multiple is equal to 10. Sometimes you'll see this written as 10 times, where we are saying that the price of the share is 10 times the earnings. As a quick interpretation, what this essentially means is that for $1 of earnings, the market is willing to pay $10. So the PE ratio represents how much a share is worth per dollar of earnings. So in our example, that means that for $5 of earnings, the market is willing to pay $50. So that is a quick interpretation of the most commonly used price multiple, which is the PE ratio. Now the question is, which earnings are we using? Are we using the historical earnings, which would be, if we are doing earnings for a 1 year period, the question is which 1 year period are we talking about? If we are at this point, time 0, either we could use the earnings for the last 12 months or the trailing 12 months, or we could use the expected or anticipated or forecasted earnings for the next 12 months. And both numbers are used. When we do the current price divided by the expected earnings over the last 12 months, that's called a historical or trailing PE ratio, or a historical or trailing multiple. So let's say that this 5 represented the earnings over the last 12 months. Then 10 would be the trailing PE ratio. Now assume that this company is doing extremely well, and let's say that over the next year we are expecting earnings, so E1, which is a forecast, is equal to 10. So we expect that over the next 12 months, this period, the earnings will be 10. Then the PE ratio would be P over E1, which is equal to 50 over 10, which is equal to 5 times. So for a growing company, in this case with the earnings going up, the leading multiple will be less than the trailing multiple, because the price in both cases is P0. So the numerator is the same. With a leading multiple, if earnings are going up, then the denominator goes up. And just to complete this discussion on PE, the exact formula for the historical or trailing multiple would be written as P0, current price, over E0. E0 represents the earnings per share for the recently concluded 12-month period. Now I focused on price earnings ratio here because that's the most commonly used multiple. There are several other multiples which are also used. and those are price per sales. So this would be price per share divided by revenue or sales per share. You might also see price over book value. This is price per share divided by the book value per share. Book value, again, as a quick refresher, is the equity of a company. So it's the book value of assets minus book value of liabilities. So that's equal to the book value of equity, and it's generally summarized as book value. You can also have price divided by cash flow per share. So those are some other commonly used ratios, but the general concept is similar to what I have talked about. Later on we'll talk about pros and cons of some of these different ratios. Next, how are price multiples used in valuation? Very simplistically put, if you have a new company that you are trying to value, so the company just went public, and let's say that the typical PE ratio, let's say that the leading PE ratio in that industry is 5. Now, if this company is very much like the industry in which it is operating, and the expected or forecasted earnings for this company equal $7 per share, then using this method we can say that the expected price, or what we would expect the company to be worth, is equal to 7 multiplied by the PE ratio, which is 5. 7 times 5, which is 35. So this is one way in which this method is used. Another way is where, for an existing company, if the industry average PE is 5, and for a given company currently when we do P over E1, let's say we get 6. Now this would imply that the company that we are evaluating, which is this one, seems overpriced. So unless there is a good reason why investors are paying $6 per share, $6 per dollar of earnings for this company, whereas on average in the industry we have a PE ratio of only 5. So unless there is a good reason for this, we can say that probably this share is overpriced or overvalued. So the PE ratio is also used for relative valuation. Next, let's talk about how multiples can be calculated, and there are two ways of doing this. One is based on fundamentals and the other is based on comparables. So let's talk first about multiples based on fundamentals. The basic idea is this. You've already seen the dividend discount model, which says that the price of a share is equal to D1 over R, which is the cost of equity, minus G, which is the growth rate. If we divide both sides of this equation by, let's say, E1, so P over E1, so this is your leading or forward-looking PE ratio, and we also divide the right side of the equation by E1. So your basic maths, when you're dividing this whole fraction by E1, it's the same as simply dividing the numerator by E1. So we can see that the PE ratio is equal to D1 over E1 divided by R minus G. Now this should look familiar. D1 over E1 is simply equal to our payout ratio. So payout, as a quick refresher, payout is how much of our earnings we pay out. So for a company that has earnings of 100, and if it pays out 60 and retains 40, then the payout ratio is the dividend which it pays out divided by the earnings. So here the payout ratio is 0.6. So essentially D1 over E1 is the payout ratio. So in a typical CFA question on this subject, you might be given the payout ratio, you might be given the discount rate of say 12%, minus you might be given a growth rate of 2%. So to do this example, let's say our payout ratio is 0.6. and our cost of equity is 12% minus 2% is our growth. So in the denominator we have 0.12 minus 0.02, so 0.6 over 0.1. So in this case the PE ratio is equal to 6, or the forward PE ratio is 6. So this method of calculating the PE ratio, or the 6 that we get, is sometimes also called the justified PE. Why do we call it the justified PE? This is because we are saying that the PE of 6 is justified based on our estimate and our forecast of D1, based on our forecast, or our estimate of the cost of equity and our forecast of the growth rate. So we are coming up with a PE ratio based on what we expect to happen with that company, and hence this is called the justified PE. How can we use this? Let's say our justified PE is 6, but in the market, given the actual market price, so then let's say given the market price divided by expected earnings, if that is equal to 5, this would imply that our share is undervalued, because we are saying that given our estimates for $1 of earnings, we should have a price of 6. But in the market, it is only priced at 5 times earnings. So unless there is a good reason for why we have this discrepancy, this would suggest that the share is undervalued and hence should be bought. Another concept on this subject is that of dividend displacement of earnings. What does this mean? Just to write this equation again, P over E1, our PE ratio, is equal to the payout ratio divided by R minus G. Now a question might come up: what happens if a company increases its dividend, or more precisely increases its payout ratio? Will the PE multiple go up or down? And you might quickly be prompted to simply look at the numerator and say that if our payout ratio is going up, then the PE ratio will go up. But that would be missing a point. The fact is that we also have this growth rate in the denominator, and if you recall from our last segment, growth rate is equal to ROE multiplied by the retention ratio, and retention ratio is nothing but 1 minus the payout ratio. So notice that if the payout ratio is going up, that means the retention ratio is going down. If the retention ratio is going down, that means growth rate is going down. If the growth rate is going down, that means that this whole denominator is going up. If the denominator is going up, that means that because of this denominator going up, the PE ratio is coming down. So the point here being that just because the dividend is going up doesn't necessarily mean the PE is going up, because both our numerator as well as our denominator are going up. So the impact on the earnings and the PE ratio will be ambiguous, and this ambiguity is generally referred to as the dividend displacement of earnings. So higher dividend is good in one sense, but on the other hand it would decrease the growth rate and decrease the future earnings. So that's an important point. Next, let's talk about multiples based on comparables. Here the idea is straightforward, and it is based on the law of one price. Let's just understand this simple law of economics first. The idea is this: if you have 3 items A, B and C, and all these 3 items are very similar, then the law of one price implies that if A is worth $5 and B is very similar to A, then you would expect the price of B to also be 5, and if C is also similar, then you would expect C to be 5 also. Now if we extend this very simplistic model to equity valuation, we can say that if we have 3 different shares A, B and C, and these represent three different companies that are in the same line of business, same industry, similar demand drivers, similar issues impacting them, then their price should be the same. But what price are we talking about? Are we simply saying that if we are talking about, say, 3 fertilizer companies in Pakistan, they should all have the same share price? That is not the case, because the 3 companies can be of different size. So what we really mean here is, by the law of one price in the context of shares, we mean that the multiples should be the same. So the PE ratio of A and the PE ratio of B and the PE ratio of C should be the same, as long as all these 3 companies are very similar. And essentially then what that is saying is, the earnings of A, earnings of B, earnings of C can be different, but so if earnings of A is 1, earnings of B is 2 and earnings of C is 3, then the price should increase in proportion to the earnings, and hence the PE ratio should be the same. So to make this simple, let's say that for A, earnings are 1 and the price is 10, which makes the PE 10. Then based on the law of comparables, since we are saying that the price should be 10 per dollar of earnings, then in the case of B, the price should be 20, because we have $2 of earnings. And in the case of company C, the price should be 30, because it is based on $3 of earnings per share. So this is a method based on comparables. Now how do we use this? If you have let's say a company D now, and this company D is being valued. Let's say this company D is in the same industry as these 3 companies. So if company D is in the same industry, we would expect the PE ratio for D to be equal to 10. So this is what we would expect given the industry. But let's say that the PE ratio for D is equal to 11. What does this say? This is saying that D is overvalued, because for D, investors are paying $11 per dollar of earnings, and that seems to be overvalued relative to the industry. On the other hand, if D's PE was equal to 9, then that would imply that this is undervalued, because investors are only paying $9 per dollars of earning, given that the industry average is 10. I have done these numbers for PE ratios. A similar analysis can be done for price to book value, price to sales, and price to cash flow. So these are just some examples of different multiples that can be used. Now let us talk about the concept of enterprise value. In simplistic terms, enterprise value is equal to the market value of equity plus the market value of debt. So for a given company, and this is an approximation, I'll give you a more precise relationship in a minute. The enterprise value is equal to the market value of equity. So for a given company, let's say that the number of shares outstanding multiplied by share price gives you a market value of equity of 150 million, and let's say that the market value of the debt outstanding is 50 million. Then the enterprise value for this company is approximately equal to 200 million. And this value, enterprise value, as you can see from this relationship, represents the overall market value of the company. So it doesn't just take an equity perspective, it looks at both the major shareholders, the major investors, equity holders as well as debt holders, and it is saying what is the collective value of the enterprise given both the value of equity as well as the value of debt. Now, and this concept is important for firms that have a relatively high percentage of debt in their capital structure. A more precise relationship or more precise formula for enterprise value is the following. It's the market value of equity minus the value of marketable securities and investments. The idea being that if a company has, say, $10 million worth of marketable securities and other investments that are not part of the core enterprise, then that 10 million is part of the equity value, but it is not really part of the enterprise, since this represents marketable securities that might be invested elsewhere. So when you talk about a precise version of enterprise value, you need to subtract the value of marketable securities, but obviously you still need to include the market value of debt. This is the debt which has been taken by the company, and we need to use the market value. So if we take a market value of equity as 150 million, just like above, but this company also has marketable securities worth 10 million, and let's say that the market value of debt is still 50 million, then the enterprise value is 190 million. So in simplistic terms, enterprise value represents the value of this enterprise, and clearly any investments that the firm has made elsewhere are just subtracted from market value plus market value of equity plus market value of debt. Now let's talk about an important ratio, which is enterprise value divided by EBITDA. We've already talked about enterprise value, so let's understand EBITDA. EBITDA stands for earnings before interest, taxes, depreciation and amortization. So if you look at a very simple income statement, you have your revenue, let's say that's 100, you have your cost of sales, say that is 60, and then you might have other expenses, so other expenses which are, let's say, 10, and then you have depreciation, which might be also 10. You might have interest, which is, let's say, 5, and then you have earnings before tax, which is some number, your tax, and then earnings after tax. The point here being that obviously the earnings after tax is the earnings available to shareholders. That's one point. The other point is that we have subtracted any interest that is paid out, because this earnings is from the perspective of equity holders. But EBITDA represents cash flow to all investors. So all investors being both the bond holders as well as the shareholders. So that is why we want to take the earnings before the interest is paid out. So we are concerned with this. Then, since we are concerned with cash flow and depreciation is a non-cash charge, we should actually be concerned with this number above here. So as far as we are concerned, in this particular case, EBITDA is simply going to be 100 minus 60, which is 40, minus 10, which is 30. So the overall cash flow, or at least an approximation of the cash flow which is available to bondholders and shareholders, is 30. Now there are limitations to this, where obviously we've not included the money that is paid out as tax, but nevertheless EBITDA is a frequently used approximation for the cash that is available to bondholders as well as shareholders. And now coming to the ratio, enterprise value divided by EBITDA. So this is telling us how much value does the enterprise have per dollar of EBITDA. So if a given firm has enterprise value worth 10 million and EBITDA is 1 million, then for this entity the ratio is 10, which means that for $1 of EBITDA we have a value of $10. and therefore for 1 million worth of EBITDA the value is 10 million. This again, the way this ratio can be used is like what we have seen before. From an investment perspective, let's say that the average value in the industry for this ratio is equal to 9. So this implies that on average enterprise value should be 9 times more than EBITDA. But if the company we are evaluating has a EBITDA equal to, has a ratio equal to 10, that would imply that this company is overvalued. So unless there is a good reason why the enterprise value is higher for this company is overvalued. Obviously, if it has a strategic advantage which can explain the higher multiple, then that's all right. But if there is no way to explain the higher multiple, then that would imply that this company is overvalued. Asset-based models. So as a quick high-level recap, we have talked about 3 kinds of valuation models. The first kind was based on discounted cash flow, the second kind was based on multiples, and now a third category is asset-based models. In asset-based models, conceptually these are very straightforward. All we are saying here is that valuation is based on the value of assets. So value of assets minus the value of liabilities gives us the value of a company. This model is relatively easy to use if the market, and obviously here we would be more concerned with the market value of assets and market value of liabilities. Why? Because book value of assets might be very different from market value, and clearly if you are valuing a company, you are concerned with the market values. So in organizations which have very liquid assets, it would be relatively easy to determine the market value of assets, and generally it is easy to determine the market value of liabilities. So as long as you can easily determine the market value of assets and market value of liabilities, you can then determine the value of the firm based on market value of assets minus market value of liabilities. Now if for some entities this ratio or these numbers are not easily identified, so for say manufacturing companies where the assets have been around for a long time and very hard to value, then this asset-based model is very hard to use.